Welcome to the deep dive. Today, we're plunging into the pretty complex world of Stratasys Ltd, ticker symbol NASDAQ SSYS.
That's right.
This company is a genuine pioneer in 3D printing, a technology that really promises to fundamentally reshape how we make things. But here's the million-dollar question we're unpacking for you today.
Mm.
Is Stratasys a hidden gem, a true value opportunity just waiting to transform its technological leadership into serious shareholder profits?
Oh.
Or in this fiercely competitive and rapidly evolving industry, is it actually a value trap, kind of masquerading as something it's not? We're going to dive deep into exactly that today.
That really is the core dilemma, isn't it? And it's a
Sure.
fascinating one. Our mission in this deep dive is to give you a comprehensive, long-term, value-oriented investor's perspective on Stratasys.
Right.
We've pulled together extensive research and sources, and we're here to, cut through the noise, distill the most important nuggets of knowledge, and really help you understand what truly matters.
Okay, so to navigate this, we've structured our deep dive into two main parts. In part one, we'll break down the core business itself, take a look at its management team, and then rigorously examine its financial health.
Makes sense.
Then in part two, we'll shift our focus to market sentiment, ownership dynamics, the major risks involved, and finally, bring all these threads together in our conclusion. So let's jump right into part one. We begin with chapter one, the business of 3D printing. Understanding Stratasys' core.
Okay, so as of our analysis on August 17th, 2025, with shares trading around $9.40, Stratasys is a global leader in additive manufacturing.
Leader.
Yeah, and when you look at their business model, it's actually pretty familiar, often compared to Gillette or maybe even Keurig.
Okay, that razor and blades model. So they sell the 3D printer, that's the razor. But where's the real recurring revenue coming from? Is it truly the blades?
Exactly. The initial printer sale is important, sure, but the consistent high-margin revenue comes from those proprietary consumables, the polymers, the resins, other materials that customers have to keep buying to operate the machine.
Ah, so it's locked in.
Think of it as a walled garden
Mm-hmm.
for supplies, yeah. On top of that, they have a second significant revenue stream from services. That includes installation, maintenance, and even their own contract manufacturing division, Stratasys Direct Manufacturing, or SDM.
And how significant are those recurring revenues? Can you give us a sense of the scale there?
Oh, very significant. For example, in fiscal year 2023, their products, so the razors and blades together, generated about $434 million.
Okay.
But their services brought in another $194 million.
Wow.
That dual stream isn't just about revenue. It creates incredibly sticky customers and a more predictable income flow, which is, crucial for long-term stability.
So their foundation is in polymer-based technologies. What are the key ones that really define Stratasys' offering?
Well, their two cornerstone technologies are fused deposition modeling, FDM, which was actually invented by co-founder Scott Crump.
Oh, really?
Yeah, and PolyJet. FDM is known for producing durable functional parts, so it's widely used in industrial applications.
Right.
PolyJet, on the other hand, is more like an inkjet printer for objects. It uses liquid photopolymers to create incredibly smooth surfaces, fine details, and even multi-material or multicolor prints.
Ah, okay. More intricate stuff.
Exactly. It's often used for, complex prototypes and medical models.
It's one thing to have established tech, but are they still pushing the envelope? I'm curious about new product lines like the Neo 800 Plus and this GrabCAD Print Pro software. What do those tell us about their future direction?
They're absolutely innovating. In March 2025, they unveiled the Neo 800 Plus TE, which is a large format stereolithography, or SLA, printer. It's specifically targeting high-value sectors like aerospace and automotive.
Okay.
But you hit on something crucial there. Their software ecosystem, especially GrabCAD Print Pro, that's a really significant strategic move.
How vital is that software to their overall strategy? Is it truly a game changer for customer retention?
It really is. GrabCAD Print Pro streamlines the entire workflow, from design right through to print. This creates a powerful lock-in effect.
Ah, the stickiness again.
Exactly. Once customers integrate it into their operations, switching to a competitor becomes a much more complex and costly endeavor. It's a classic example of creating high switching costs. It's a powerful competitive advantage.
So with this technology and ecosystem, what's Stratasys' market position? Are they a big player?
They definitely are. They're recognized as a global pioneer and a leader in additive manufacturing. We're talking about a company with approximately 2,000 employees, 27 global offices, and over 200 agents and resellers worldwide.
That's quite a footprint.
It is. Their scale is significant.
Yeah.
And underpinning all of that is a formidable intellectual property portfolio around 2,600 granted or pending patents. That provides a strong legal moat.
And geographically, how diversified are their revenues? Are they too reliant on one region?
No, they're quite diversified, actually, which is a strength.
Mhm.
Last year, the Americas made up the biggest slice, nearly $390 million.
Okay.
EMEA, so Europe, the Middle East, and Africa, contributed about $156 million, and Asia-Pacific was around $82 million. This global footprint provides a nice cushion against downturns in any single market.
So what does this all mean for their primary value proposition to customers? How has that, evolved over time?
I think the biggest evolution is the shift from just rapid prototyping.
Which is what 3D printing used to be all about, right? Making models.
Exactly. To direct digital manufacturing, or DDM. This means 3D printing isn't just for models anymore. It's for producing final end-use parts, tools, jigs, fixtures
And
directly.
actual functional parts.
Precisely. For customers, this translates into accelerated product development, supply chain agility like Toyota, using their tech to improve lead times and reduce reliance on distant suppliers.
Interesting example.
Yeah. And even mass customization, like creating patient-specific medical devices. It's really about moving from design to final product faster and more efficiently.
That's a huge shift in capability. Now, let's zoom out to the broader 3D printing market itself. What are the macro trends and growth potentials we're looking at here?
Well, the market is basically on the verge of explosive growth. Projections show it jumping from about, say, $29 billion in 2025 to well over $100 billion by 2032, 2034.
Wow, that's huge.
It is. That's a compound annual growth rate, a CGR, of something like 17 to 24%. And this isn't just hype. It's driven by real trends, like the integration of AI and IoT with manufacturing, the development of increasingly advanced materials, and this global push for sustainability and decentralized manufacturing.
That whole design global, manufacture local idea.
Exactly that philosophy.
But with that kind of growth potential, there must be intense competition, right? It can't be just Stratasys.
Oh, absolutely. The landscape is highly competitive and, frankly, fragmented. Their most direct and often compared rival is 3D Systems, ticker DDD.
Right, DDD. We hear that comparison a lot.
Yeah. And while Stratasys has higher revenue and better, though still negative margins compared to 3D Systems, it's a constant battle for market share. Beyond DDD, you have industrial giants like HP Inc. getting into the space, specialized players like EOS and Materialize, and even, low-cost disruptors kind of popping up like Bamboo Lab.
So they're battling it out with rivals like 3D Systems, but are there other forces at play shaping this industry? What about the regulatory environment? Does that create unique challenges or maybe even advantages for a company like Stratasys?
It's definitely a factor. The regulatory environment is, well, it's a complex patchwork. You've got FDA approvals for medical devices, FAA certifications for aerospace parts, EPA regulations for emissions like VOCs from ABS materials.
Lots of hurdles.
Lots of hurdles. But this complexity, while challenging, actually creates a significant moat for established companies like Stratasys. They have the resources, the expertise to navigate these hurdles. That's a major barrier for new entrants.
So it sounds like building a 3D printing giant from scratch isn't exactly easy then. What are those formidable barriers to entry you're talking about, especially in the industrial space?
You're right, it's not easy at all. The main hurdles, especially in that industrial grade segment, are 1, high capital costs. We're talking printers that can cost hundreds of thousands of dollars.
Okay, steep price tag.
Very. Then there's the need for highly specialized technical expertise to operate and maintain these complex systems. But perhaps the biggest barrier, especially for Stratasys, is intellectual property. That portfolio of 2,600 patents makes direct replication of their core technologies incredibly difficult. It's a strong legal defense.
Okay, so if we zoom out to Stratasys' overall competitive advantages, what truly stands out? What are the key strengths?
Well, their brand strength, given their pioneer status, is undeniable.
Yeah.
It builds trust and recognition. However, here's the critical part. They have a significant weakness when it comes to cost advantages.
Oh.
Their long history of negative operating margins and, frankly, inconsistent GAAP profitability indicates they haven't really achieved the kind of economies of scale you might expect from a market leader. It's a persistent challenge for them.
So where did they really shine then in terms of their competitive moat, if not cost?
Their strongest advantage really lies in those network effects and switching costs we talked about. That walled garden approach, combining the integrated hardware, their proprietary materials, and that GrabCAD software. It creates a powerful lock-in effect.
Right. Once you're in, it's hard to leave.
Exactly. Once a customer is embedded in their ecosystem, the cost and effort of switching to a competitor are very high. And of course, those 2,600 patents serve as that crucial legal moat, protecting their innovations.
Now that we understand the business, let's shift gears and look at the people running it. This is Chapter 2, Management Evaluation. What's the track record of the CEO, Dr. Yoav Zeif? He came in around 2020, right?
That's right, 2020. And he's been focused on strategic realignment. He's had to steer the company through some pretty tough macroeconomic headwinds.
Like the recent cost cuts?
Exactly. For instance, his decision to initiate that 15% workforce reduction to achieve $40 million in annual cost savings that shows a clear commitment to financial discipline. He's been actively trying to, right-size the company for the current environment.
And in terms of communication and ethical reputation, are they transparent with investors? How do they handle things like takeover attempts?
They are quite transparent, generally.
Yeah.
They provide regular detailed financial outlooks and hold earnings calls, which is good practice. You also see them employ things like a poison pill shareholder rights plan, which they've extended to December 2025.
Ah, the poison pill, a defense tactic.
Right. Think of it as a corporate self-defense mechanism. It's designed to deter unwanted takeovers and help ensure shareholders get a fair shake, as they sort of signaled when Fortissimo Capital came in with that strategic investment.
Moving on to capital allocation, how is management deploying the company's capital? Are they investing back into the core business, or is M&A a big part of their strategy now?
They're definitely doing both. They're investing organically with about $25–30 million in capital expenditures planned for 2025, plus consistent R&D spend.
Okay.
But what's really fascinating here, and maybe a key indicator of their future direction, is that $120 million equity investment they received from Fortissimo Capital.
Right, the strategic investor.
Yeah, and that capital is explicitly earmarked for inorganic value creation opportunities. In other words, growth through acquisitions.
So M&A is clearly on the table.
Very much so. This signals a clear focus on M&A, which, while it offers potential for rapid expansion, also carries, higher execution risk.
And what about share buybacks or dividends? Are they returning capital directly to shareholders in any way?
Stratasys doesn't pay dividends. Their stated policy is always to reinvest earnings for growth.
Yeah.
Interestingly, though, they did authorize a $50 million share repurchase program back in September 2024.
Which usually signals management thinks the stock is cheap.
Typically, yes. However, by June 2025, only $2 million of that had actually been deployed.
Only $2 million out of 50.
Yeah. It sends a somewhat contradictory message, right? The authorization suggests confidence, but the limited execution, especially alongside issuing equity to Fortissimo, kind of signals strategic ambition, but maybe highlights current operational weakness or perhaps just a lack of urgency on the buyback front.
How efficiently are they actually using their capital? Let's talk about return on invested capital, ROIC. That's a crucial metric for value creation.
This is a core weakness for Stratasys.
Yeah.
And frankly, it's a major red flag for investors.
How bad is it?
Their ROIC has been consistently and deeply negative. On a trailing 12-month basis, it's standing at a troubling negative 9.17%.
Minus 9%. Ouch.
Yeah. And when you compare that to their weighted average cost of capital, their WACC, which is very high, at 14.68%.
Whoa, nearly 15% WACC. That's high.
It is high. It means they are currently destroying value with the capital they invest. They aren't generating nearly enough return to cover their cost of capital. This just highlights the immense urgency of their turnaround efforts.
With those insights into management, let's dive into Chapter 3, Financial Analysis. What do the hard numbers tell us about Stratasys' financial health? Starting with the market cap as of August 17th, 2025.
Okay, their market capitalization is approximately $674.8 million. That's based on that $9.40 share price and about 71.78 million shares outstanding.
And their revenue growth trends over the past 5 years, how has the top line been performing? Has it been steady?
Volatile, to say the least. After a decline in 2020, they saw a rebound in 2021-2022.
Okay, some recovery.
Yeah, but then they've now experienced 2 consecutive years of declining revenue.
Yeah.
Fiscal year 2023 was down 3.7%, and FY 2024 was down 8.8%.
Oof, 2 years down? That indicates significant headwinds.
It really does. A
Yeah.
struggle to grow that top line consistently.
So their core business seems to bring in good gross margins, but then it all falls apart at the operating and net profit levels. Can you break down those profit margins for us?
Exactly. While that razor and blades model brings in a respectable gross margin around 43% TTM, so the core product sales are profitable before overheads.
Which is decent.
It is decent, but the picture quickly darkens after that. Their operating margin is deeply negative at negative 11.2% TTM. That shows significant losses after you factor in R&D and SG&A expenses.
Okay.
And their net profit margin is even weaker at negative 19.2% TTM.
Minus 19% net margin.
Yeah. To put it simply, they lost over 19 cents for every dollar of revenue they brought in. And this chronic unprofitability, it's been a consistent challenge for many, many years.
And if they're not profitable on paper, how are they doing with free cash flow? Are they actually generating cash from operations?
Not consistently, no. Their free cash flow generation has been highly erratic and mostly negative. For example, it was minus $3.1 million in 2024.
Still burning cash, then?
Yeah. It indicates that the business is not yet self-sustaining from a cash perspective. It can't fund its own operations and growth purely from its earnings.
This raises an important question about financial stability. How consistent are their earnings, and what about their debt situation? Is the balance sheet strong?
Consistency. Earnings consistency is almost non-existent. They've reported GAAP losses for over a decade.
A decade of losses.
Pretty much. For instance, their diluted earnings per share, EPS, was Medix of $0.70 in 2024, and it was Medicus of $8 or 8 cents back in 2020. This persistent unprofitability is a primary risk. However, and this is a crucial paradox, their balance sheet is remarkably strong. They have no long-term debt.
No debt? That's a huge positive.
It's a major strength. Provides incredible stability and flexibility.
And their current ratio, short-term liquidity?
Exceptionally strong. It's 3.02. That means they have over 3 times as many current assets as current liabilities. Robust short-term liquidity.
So you have this really striking paradox, then.
Exactly. A fortress-like balance sheet, no debt, high liquidity contrasted with a consistently unprofitable income statement and negative cash flow. The financial strength they possess comes from past capital raises, not from current profitable operations.
And as we mentioned, they don't pay dividends, reinvesting everything for growth. So with negative earnings, traditional PE ratios aren't meaningful here. How do we value Stratasys using other metrics?
Correct. PE is meaningless. But if we look at price to sales, it's 1.39 TTM. That's actually higher than a direct competitor like 3D Systems' 0.60. It suggests the market assigns a higher value to Stratasys' revenue, perhaps due to that recurring nature.
Interesting.
But what's truly fascinating here, I think, is their price-to-book ratio. It's 0.88.
Below 1.
Yeah, below 1.0. That's a classic indicator of potential undervaluation from an asset perspective. It suggests there might be a margin of safety for investors based on the company's tangible assets.
So the market seems to be betting on a future turnaround, perhaps backed by those tangible assets. What about intrinsic valuation? When we run a discounted cash flow, a DCF model, which, as our listeners know, is about projecting future cash flows back to today's value, what does that suggest?
Well, when we run an educational DCF model on Stratasys, our base case suggests an intrinsic value of about $13.03 per share.
$13, okay, compared to the $9.40 price now. What are the key assumptions driving that valuation? That seems like decent upside.
It does, but you have to look at the assumptions. The model uses a pretty conservative 1.2% short-term growth rate, normalizing to about 2.5% terminal growth. But the critical factor driving the result is the very high discount rate, or WACC, of 14.68%.
That high WACC again.
Exactly. It reflects the significant risk we've been talking about, the unprofitability, the volatile cash flows, the overall uncertainty of their turnaround. A higher discount rate means a lower present value, so this valuation really bakes in a lot of caution.
Now that we've thoroughly examined the business, management, and financials, let's transition into part 2. Market sentiment, ownership, risks, and conclusion. We start this section with Chapter 4, Market Sentiment. How does Wall Street perceive Stratasys right now? What are the analysts saying?
Well, Wall Street analysts are perhaps surprisingly broadly optimistic. It presents an interesting contrast to some of the financial numbers we just discussed.
Really? Optimistic?
Yeah. The consensus is a moderate buy or even a strong buy, with an average brokerage recommendation, or ABR, of 1.60. Their average 12-month price target is quite bullish, ranging from about $12.20 to $14.33.
So potential 30–50% upside from the current $9.40 price.
Exactly. That's what the analysts are forecasting, on average.
So there's a clear disconnect here then. Analysts seem to be focusing on maybe that price-to-book ratio and the long-term industry growth potential, while the broader market seems to react more to the immediate negative news, like earnings. What's the general media tone been like, especially after the recent Q2 earnings?
Predominantly negative, you're right. The Q2 2025 earnings release on August 13 saw the stock drop nearly 14% on the news.
Ouch!
Yeah. Management cited challenging macroeconomic conditions leading to delayed capital expenditures and longer sales cycles. This really overshadowed some genuinely positive strategic partnerships they announced, like with Toyota and Andretti Global and some new product launches.
So the market focused on the bad news.
It seems so. Fixated on the short-term revenue dip.
What about market indicators like short interest? What does that tell us about investor confidence, or maybe the lack thereof?
Short interest is actually relatively low. It's 2.64% of the float as of July 31st, 2025. Now, while that's low, generally under 5% isn't considered extreme. It did see a 5.3% increase from the prior month.
So a slight buildup of negative sentiment.
A slight buildup, yeah, indicates maybe a building, albeit still small, negative sentiment among some traders.
And where is the current price relative to its moving averages? Are the technical signals looking bullish or bearish?
Definitely bearish on the technicals. The current price of $9.40 is significantly below both its 50-day moving average, which is around 10.96 cents, and its 200-day moving average, around $10.51.
Okay, clearly below both key levels.
Yeah, this is a strong bearish technical signal indicating a downward trend in both the short and long term.
This brings us to Chapter 5, ownership structure. Who actually owns Stratasys, and what does that tell us about its future?
Well, it's predominantly owned by institutions. Depending on the source, it's anywhere from 32% to maybe 75% institutional ownership.
Okay, so the big funds.
Yeah. And what's particularly insightful is that it's highly concentrated. The top 25 shareholders control over 66% of the company.
That's very concentrated.
It is. But what's truly fascinating is the dynamic among those key institutional holders. It's not just passive money.
Okay, let's unpack that. Who are the big players and what's their agenda? What's the story there?
Well, the largest shareholder is FF6SS Limited Partnership, which is Fortissimo Capital. They hold 13.9%. They're seen as a friendly, strategic investor, specifically funding those M&A opportunities we talked about.
Right, the $120 million investment.
Exactly. However, the second largest holder, with 11.5%, is Nano Dimension Ltd.
Nano Dimension. They're a direct competitor, aren't they?
They are, and they have a history of aggressive, hostile takeover bids for Stratasys.
Ah, so there's drama.
There is. It creates this kind of battle of the titans dynamic. You have a supportive strategic partner on one side, Fortissimo, and a rival with a large adversarial stake on the other, Nano Dimension. This could significantly shape the company's future strategy and direction. It adds a layer of uncertainty.
That's a massive factor to consider. What about insider holdings? Are the people running the company, the executives, the board, putting their own money into the stock?
This is an alarming point, and frankly, a major red flag for investors looking for alignment between management and shareholders.
How low is it?
Insider ownership is effectively NB00%.
Zero, really?
Effectively zero, yes. And critically, there have been zero open market purchases or sales by insiders in the last 12 months. None.
Okay, that starkly contradicts the share buyback authorization, doesn't it?
It absolutely does. They authorize a $50 million buyback, suggesting the stock is cheap, but management themselves haven't bought a single share on the open market in a year. It raises serious questions about their own conviction in the company's current valuation and future prospects. If management isn't buying, why should outside investors?
That's a very fair question. And this high ownership concentration, with a few major players holding so much sway, what does that mean for smaller retail investors like many of our listeners?
It means diminished influence, really. Retail investors have less say in corporate governance when ownership is this concentrated. Also, it can lead to increased volatility. If one or two of those major institutional holders decide to change their positions significantly, it can cause pretty big price swings up or down.
Let's turn our attention now to Chapter 6, Risk Assessment. We can break this down using a classic SWOT analysis: strengths, weaknesses, opportunities, threats. What are Stratasys' core strengths right now?
Okay, strengths. Number one has to be that fortress balance sheet. No debt, exceptionally strong current ratio above 3.0. That provides financial stability and flexibility, especially for M&A.
Right, the debt-free status.
Second, that robust intellectual property moat, the 2,600 or so patents. And third, their established brand and large installed base, which generates that crucial recurring revenue from consumables and services.
On the flip side, what are their significant weaknesses that investors really need to be aware of?
The biggest one is the chronic unprofitability. That long history of AMP net losses and the deeply negative ROIC we discussed. It's hard to overlook.
Persistent losses, yeah.
Second, the lack of insider ownership definitely raises questions about management alignment. And third, the recent revenue decline for 2 consecutive years highlights their vulnerability to macroeconomic cycles.
Okay, weaknesses noted. what opportunities are on the horizon that could truly benefit Stratasys if things go right?
Well, the additive
Riding a big wave.
Exactly. Stratasys is also well positioned for M&A and industry consolidation, thanks to its strong balance sheet and that fortissimo capital investment. And the global onshoring or reshoring trend, driven by geopolitical factors and supply chain issues, creates a powerful long-term catalyst for 3D printing in general.
And finally, on the SWOT, what are the primary threats that could derail their progress or the turnaround story?
Intense competition is a major one, from established rivals like 3D Systems and HP, but also from those aggressive, low-cost newcomers. Macroeconomic headwinds, particularly high interest rates right now, are clearly delaying customer capital spending and slowing down sales cycles.
We saw that in the Q2 results.
Exactly. And geopolitical tariffs, which we should probably unpack a bit more, increase input costs, creating year-term pressure on margins.
So on those macroeconomic factors, how do high interest rates specifically impact Stratasys' business? It seems pretty direct.
It's quite direct, yeah. When interest rates are high, it simply makes industrial 3D printers, which are significant capital expenditures, more expensive for customers to finance.
Makes sense.
This leads to delayed sales decisions, longer sales cycles, and directly impacts Stratasys' revenue growth. So you could say an investment in Stratasys today is partly a bet on future macroeconomic improvement, like lower interest rates eventually unlocking that pent-up demand for capital goods.
Let's talk about that specific geopolitical factor. The U.S. imposed tariffs of 2025. This seems like a real double-edged sword for Stratasys. How do they balance the negative and potential positive impacts?
It truly is a double-edged sword. On one hand, as a direct threat, tariffs ranging from 10% to 25% on goods from places like China, Canada, Mexico, that increases Stratasys' costs for raw materials and components. That definitely pressures their gross margins in the short term.
Okay, the negative side.
Right. However, and this is crucial for the long-term story, these same tariffs create a powerful incentive for Stratasys' customers to adopt 3D printing for onshoring or reshoring their own production.
So the tariffs make localized 3D printing more attractive.
Exactly. By enabling localized manufacturing, 3D printing helps companies bypass these tariffs and significantly reduce their supply chain vulnerabilities. So, over a multi-year horizon, this strategic benefit, this tailwind for adoption, likely outweighs the short-term cost increase for Stratasys itself.
This brings us to Chapter 7, Conclusion. Let's try to synthesize all our findings now. What are the strongest bullish points for Stratasys? What's the core of the bull case?
Okay, the bull case. I think it leans heavily on its asset-based valuation, primarily that price-to-book ratio of about 0.88, suggesting it might be trading below its net asset value.
Asset safety net, maybe?
Potentially. Secondly, its financial strength, that debt-free balance sheet and strong current ratio, provides incredible stability and M&A flexibility. That's a huge plus.
Can't ignore the zero debt.
Definitely not. Thirdly, there are those powerful industry tailwinds. It's a leader in a high-growth market. And that growth is potentially accelerated by onshoring trends and even the 2025 tariffs acting as a catalyst. And finally, that durable competitive moat protected by its extensive patents and the high switching costs from its integrated ecosystem.
Okay, that's the bull case. Now, what about the bearish points? What's the core of the bear case? What are the biggest red flags here?
The bear case starts with the persistent unprofitability. That long history of gap losses and the deeply negative ROIC are major concerns that you just can't ignore.
The elephant in the room.
It really is. Secondly, the slowing growth and macro dependency. 2 consecutive years of declining revenue show its vulnerability, and recovery seems largely tied to external macroeconomic factors like interest rates improving.
Out of their direct control.
Largely, yes. Thirdly, it's a high-risk strategy. Their reliance on M&A, often funded by potentially dilutive equity like the Fortissimo deal, introduces significant execution risk, and that's exacerbated by their seemingly modest execution on the share buyback plan.
Right.
And finally, that distinct lack of insider confidence. 0 open market share purchases by senior executives in a year. That remains a significant red flag for investors.
So to quickly summarize the valuation picture again, the current share price is hovering around $9.40. Our educational DCF model suggests a base case intrinsic value, maybe closer to $13.03, but we have to emphasize this is highly sensitive to inputs, especially that very high 14.68% discount rate reflecting the risk.
And Wall Street analysts are broadly optimistic, remember, with average price targets around $12.20 to $14.33. That indicates significant upside potential. But that upside is clearly contingent on successful strategic execution and that turnaround actually happening.
So what does this all mean for you, the listener, trying to navigate this value or trap scenario? Stratasys certainly appears undervalued based on its assets and maybe analyst expectations.
Right, but that discount is arguably justified by its chronic unprofitability, its recent revenue declines, and the significant execution risk inherent in its M&A-driven growth strategy. The market isn't ignoring those issues.
This really raises an important question for you to think about. An investment in Stratasys today is not really a bet on its current, frankly, underperforming financial results, is it?
No, I don't think it is. Instead, it's an explicit bet on a successful turnaround. It's a bet that those powerful long-term tailwinds, the whole additive manufacturing revolution, the onshoring of global supply chains, will eventually lift its fortunes.
And critically,
And critically, it's a bet that the current management team, despite the lack of insider buying, can finally translate Stratasys' technological leadership and strong market position into sustainable profits and, importantly, consistent free cash flow for shareholders. That's the bet you're making.
if this deep dive helped you think differently about investing in the future of manufacturing, maybe gave you something to chew on, remember to like and subscribe to the Stock Analytics AI channel.
Yeah, definitely do that.
For just $4.99 a month, members get priority deep dives on tickers. And over the next few months, we're covering all of the S&P 500 stocks with exclusive member access. You definitely want to check that out. If you want a one-off deep dive into a specific stock that's on your mind, just drop us a super thanks.
And remember, this deep dive was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. Thank you for joining us on this deep dive. We hope it's giving you valuable insights and maybe ignited your curiosity to learn even more about Stratasys and the 3D printing space.